Hi everyone and welcome to Portfolio Watch, your guide on what's hot and not across global markets. I am Fifi Peters. Now, small to mid-cap companies are those that are outside the top 40 listed companies on the JSE, and they also generally have a market cap of below 10 billion rand. Joining me to discuss how to get the most out of investing in the JSE's listed small caps is Keith Mclachlan, who is a fund manager at AlphaWealth, and Jared Weiner, fund manager and co-founder of Westbrooke Alternative Asset Management. Gentlemen, thanks so much for your time. Now, we have seen big companies in South Africa struggle somewhat because the economy is in bad form. I'm interested in how small companies have weathered the storm. Jared, if you could just take me through the picture of what's happening in the small cap space.
Well, from an earnings perspective, where it's linked to the economy, I think it's been like the bigger companies, where there've been negative headwinds, they've also suffered. But the landscape is wide, and there still have been several companies that are putting out good earnings and managing their businesses well operationally and through corporate activity to deliver growth and decent returns. But the sector as a whole, from a share price performance perspective, has struggled. It's had a massive derating to what we now believe is the small cap sector is trading at a big discount to similar private businesses.
All right, so there is value to be had in that space, particularly amongst businesses that are managed correctly, as you say. But Keith, I mean, we were having an off-air conversation about the performance of small caps, particularly over the past 5 years. You told me something interesting, that they have underperformed or defied expectations of underperforming large caps when it should be the other way around. So what has been happening?
So let me put those stats in context, is that the small cap sub-equity asset class effectively should in the long term outperform the larger caps. And this is true of any market anywhere, like across the world. But in South Africa for the last 5 years, if you overlay small caps versus large caps, the small caps have actually underperformed.
Sure.
And in fact are negative 4 out of those 5 years. So as a statistical anomaly, one has to look at the valuation and look at the macro context. The macro context is effectively South Africa has grown very slowly. The public sector has eaten the economy's growth, is just my opinion. But it's all bled through into valuation, and we're sitting at a point now where small caps are one of the cheapest sectors in the world, and relative to other indices in other countries, including other small cap indices. So this is not a small cap thing. This is a South African small cap thing.
Right.
So it's running at 0.8 a book, which is the same valuation it had during the credit crisis and back in 2003. So we're at historical low valuations, and unfortunately it is the macro context that has arrived us here, and that's low South African growth.
So that macro context is about to change, some would argue. We're headed to elections where we are expecting our government, or the newly sworn government, to get its house in order. We need that economic growth. You say that the sector is trading at significant discounts, but I imagine that choosing the right companies is key. Jared, you alluded to good management being one of the reasons why some of the small caps within the sector have outperformed others despite the challenges. Your pick is on Grand Parade and Stellar Capital Partners. So walk us through the investment case of those two and why you are having those in your portfolio.
Okay, so one of the key themes we've tried to focus on is, because it's been very tough to call the economy and there hasn't been economic growth, our fund's a bit different. We frequently take larger stakes in companies and play a more active shareholder to push for change where we believe the companies can enhance the value for shareholders. And both of these companies are trading at deep discounts to their sum of the parts. So if we start off at Stellar Capital,
sure,
they've got an NAV of about R1.20 per share.
Just tell us a little bit about Stellar Capital for our viewers who are hearing it for the first time.
Okay, so Stellar Capital is an investment holding company that's had an interesting history where it actually placed shares a few years ago at a premium to NAV, and it was a favorite pick for an investment holding company that would grow. Mm-hmm. They made some mistakes in capital allocation, and as a result of that, the share price has really suffered. But what's happened is they've changed their strategy, which has resulted in them selling several of the assets, and they've been quite successful in the sales process in that they've exited several of those assets at premiums to what they had it on the book at, and I think to what the market believed they could get for those assets.
All right, so what are their major investments now?
So now you're looking at that the bulk of the current share price, around 90%, is going to be cash within the next few months. The TOR proceeds should be in by the end of this month, and then you've also got Amacor, which I'm hoping will be received by the end of the next quarter. So once you get to that point, the bulk is cash. Then they have an investment in a good asset management and financial services business called Prescient. So there you're buying Prescient, cash, and some smaller assets for the price really range of 65 to 70 cents. And the NAV is R1.20 to R1.25 per share. So when we look at that, we think it's very attractive to be able to buy that type of a discount of where the majority is cash. And we have started engaging with the board and management on what they do with that cash. Because what's key now is that cash is deployed correctly, or what we'd actually like is for them to give the cash back to shareholders through special dividends or share buybacks.
All right, the Grand Parade, just walk us through quickly on that. I mean, you talk about good management. I think many of us know that they made a very bad management decision in bringing Baskin Robbins and Dunkin' Donuts to the country, but why is that on your radar?
So once again, this is one going through a turnaround. As you know, we've been quite active there pushing for change. They've made changes in there's been management changes, and I think most importantly to me is the strategic changes. Baskin Robbins and Dunkin' Donuts, there will be no more capital deployed into those divisions, which I think was a major issue for the company.
Right, they're selling those.
They've actually put them into business rescue. So the cash will be stopped now. They'll go through some closure costs, and that will come to an end. The casinos are performing well. Burger King, I still think, needs some work, and we still have some questions on the capital deployment. But when you look at the sum of the parts of Grand Parade, it's at a great discount.
Sure. Keith, you have 3 on your radar that you're looking at: Santova, Master Drilling, and Storage REIT. Tell us about those.
Sure. Let me summarize Santova first. As a 4PL non-asset-based supply chain manager, it actually earns 2/3 of its earnings outside of South Africa. Capital light, highly cash generative business, but 2/3 of its earnings outside of South Africa. And the same theme rolls into Master Drilling and a couple of our other holdings where they're cheap, but they're cheap because of where they listed, not because of what they are. They're not South African companies.
Right.
2/3 of your earnings is coming from somewhere else. You're not a South African company.
Right.
So Santova sitting on a 5-6 times multiple, good management, really only scratching the surface of what they potentially could do. This is a 10, 20, 30-year play. So fantastic business. Master Drilling is really, so they specialize in the drilling segment. They earn 3/4 of their earnings outside of South Africa. Like I said, the theme continue playing. They really dominate their niche. They're the masters from Fochville, but in the raised bore drilling field, their fleet globally is 3 times bigger than their nearest competitor. They own the IP and they're continuously automating and rolling out this fleet flexibly across the world. Once again, sitting on a very low multiple, sitting on 8 times the multiple. Storage is slightly different. Storage is domestically dominates the self-storage space, sitting on a forward yield of 8%. There's an internal manco as a REIT, very, very well managed, reasonably geared, and it's got a free option in the UK where they have Storage King. Once again, superb business, well managed, and very, very low valuation.
Keith, I mean, we have seen companies go outside the country to seek more growth, but that hasn't always gone well. And especially now we're talking about a global economy that is slowing. We saw the IMF's latest forecasts. So what are the risks also associated with companies that earn so much of their profit line from outside?
First, Fifi, I'm going to stop you there. Most of the blowouts and going offshore have come from the top 40 space, where you have professional managers hired in, and they have teams of consultants with spreadsheets who are incentivized to tell them yes. So guess what? They, instead of building a business, they buy a business, and there in a foreign market, you tend to be an acquirer of last resort.
Sure.
In the small cap space, small caps have actually tended to be statistically more successful in going offshore for a number of reasons. First of all, it tends to be owner-operator. So in fact, in Master Drilling's case is a very good example. Donnie owns the majority of that business. So that's actually more or less his life savings, and I will be very surprised if going offshore, he wouldn't do it in such a prudent process and mess it up. So you've got strong alignment of interests. At the same time, you also have much smaller balance sheets. So one has to be far more prudent in going offshore, and you typically can't hire all the top investment bankers and consultants that all have their spreadsheets telling you yes. So you'll actually tend to go and make those investment capital allocations decisions yourself as a board, and that means you're far closer to the assets. And in many instances, these guys have actually built offshore businesses and they haven't bought them. So in the small cap space, it's not, there aren't direct parallels to all these top 40 blowouts we're having from bad acquisitions offshore. In fact, here over the last 10, 15 years, guys have been quite successful in slowly, organically, and in a very controlled process, building, if not piecing together businesses in offshore markets, particularly where they have strong competitive advantages.
Right. But then, I mean, we've spoken about how the sector has been performing and some of the major concerns. You've given us your picks, quite differently. I'd be interested in each other's views of the various stock picks you have listed. But also, I mean, where is the space headed, particularly as we look towards the end of 2019? Jared?
So look, my first point on it is you have seen a big increase in corporate activity over the last six months in the sector. So Clover's been taken out at a 70% premium, Tor about a 45%. You've had several others in that space. I mean, I can name a few: Wilderness, Verymark, Cargo. So I think corporate activity will continue. The key thing what the sector needs right now, if not for corporate activity, is flows to come back. Right now there aren't flows, and I think there's pretty much a wait and see approach from investors. They're waiting to see, do the elections go the right way? Do we see the economy, some growth and confidence coming back into the economy? Because then I think you'll get the flows coming back, and the value in these multiples that the companies are trading at won't last long. Because I think there's wide consensus that the sector looks very cheap. I think the problem is a big wait and see approach from investors who are rather staying in cash and not allocating capital.
Keith?
So let me take that question and invert it. Instead of defending the sector, let me ask you, as a potential investor in this sector, where you have historical low valuations, arguably improving fundamentals post-election, you have survivors in the sector. So there's good businesses, many of them earning returns offshore, domestically. They've cut to the bone, and in fact there's very good returns in equity you can find across the sector, and arguably earnings momentum going forward. So you've got trough valuations in a trough market with, as Jared touched on it, liquidity that has pulled out, and in a global context it is the cheapest sector in the world. Can you afford not to allocate at least something here? In the long term, your greatest risk is probably not being in this market at this point.
Perfect note to finish the conversation. Gentlemen, thank you so much for your time. That, of course, was Keith Mclachlan, who is a fund manager at AlphaWealth, and Jared Weiner, the fund manager and co-founder of Westbrooke Alternative Assets. Thank you to all my guests once again for joining me this evening. And remember that you can email your questions to portfoliowatch@abn360.com. And also your tweets, #PortfolioWatch, and our handle is @CNBC Africa. You can catch me at Fifi Peters. Don't forget to join us again next week, Tuesday at 7 o'clock Central African Time. Until next week, it's bye for now.
Welcome back to Portfolio Watch, where we're taking a look at the influence of commodity price cycles on the markets and, of course, the impact that it has on resource-based investment choices you make. In studio, I'm joined by Andrew Ditburner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Viv Govender, Portfolio Manager for Rand Swiss Offshore. Now, gentlemen, we certainly set the scene up just before the ad break, really trying to evaluate what's been going on within the commodities sector when it comes to exposure, but we need to talk stock-specific stuff. And what's intriguing me, firstly, before we actually jump into any stocks, is that you haven't necessarily chosen any gold counters or platinum counters, so it seems as though single commodity players aren't necessarily the flavor of the month here, Andrew.
Yeah, I wouldn't say they're not the flavour of the month. I guess, when you think of gold, I think gold does have a place in a portfolio, but from a pure commodity point of view, it's an alternative to money if you think about it. So it's a nice diversifier. If there's a monetary crisis, gold would act as a downside protection asset class there. But to get your single stock exposure through a mining company, I think is when you look what's going on in South African mining specifically.
Yes.
The input costs have been under a huge amount of pressure. These gold mines are not new mines. They're very, very old. They're very deep. So there's a lot of risks, and to try and given that gold doesn't really have there's no real use for it, industrial use for it. It's very, very difficult to try and assess what the gold price is going to do. Then you've got the US dollar that you're thrown on top of it. It just makes, I think there's a lot of risks that come into play.
Yeah.
Platinum probably less so because there's an industrial use for it through your catalytic converters.
So let's talk about some of those diversified players, many of whom have actually seen a split in some of their assets. And so let's start with BHP Billiton, one of those that's your choice. And South 32 is actually one that you're quite keen on here, Viv.
Yeah, so BHP Billiton, it's actually BHP. I think they're dropping the Billiton on there. So BHP, if you're looking at global diversified mining companies, I don't think you get a better quality company than what you'll find in BHP Billiton. And when I talk about quality, I'm talking about the quality of their portfolio, the mines that they own. And if you look where Billiton was, you go back to that time that we spoke about earlier, 2014, 2015, they didn't take nearly as much pain as some of the other global diversifieds, being your Glencores, your Anglo-Americans, etc. And that's purely because of the strength of their balance sheets, which has come through. We see even today, back then they had 26 billion net debt on their balance sheet. Today I think it's about 11 billion. That turned out 12.5 billion free cash flow in the last financial year. And the year before they did 12 billion. So if you take that, it's not going to be too long and they'll be net cash positive. I think it's a really great business if you're looking for a global diversified miner. Doesn't have exposure to South Africa, as you know. It's sold off I think about 3 years ago. Their South African operations, which has now become known as South 32.
Known now as South 32, and of course trying to remain resilient despite how volatile the local market has been. Is this one that you keep in your portfolio though?
Just a word of caution here, he chose first. so I was left with the scraps thereafter. Yeah, look, I mean, when it comes to generally comes to this kind of thing, my thesis in here is that, like you said, the single commodity miners or producers, I'm not really keen on. I think in the environment we're seeing right now, sometimes you have surprising moves, like for instance, coal versus base metals. Coal's done really well versus base metals. That separation's been there for a little while, and it's really it doesn't usually get this far apart in terms of the spread. And what I'm saying is basically in an environment where you're uncertain about the commodity pricing, you want to be basically investing in a diversified commodity producer because they have more expertise into what to put their brain power into and what to put their production into. And you have the ability, in that scenario to actually, benefit from, some of that stuff. Like you see, a number of our picks are going to be diversified producers with just one or two, single commodity, producers out there. So yes, that's my reason for going with that. I want to have a portfolio in which I rely to a certain extent on the diversified producers as actually going out there and actually giving us a bit of their alpha in terms of picking the right commodities to focus on.
Sure.
Yeah.
With that said, though, I do know that Kumba also features on your list, coupled with Anglo-American, because Kumba does fall under Anglo-American. And interesting contrast between those companies. Remember, there were rumors that Anglo was meant to sell Kumba a few years back, and that never came to fruition because they managed again to sort out their books and get their numbers right effectively. But what's your take on Kumba and Anglo-American, and perhaps if there's an investment case here for us to consider?
Yeah, look, I would go for Kumba. And actually, they're both my picks here. So, so the reason I go for Kumba is the fact that I know has been, like I said, a strange case in which we are seeing, where we predicted a couple of years ago that there'd been oversupply in the market. That has not really happened because of the changing, requirements for the grade of iron ore coming out of China. A report just came out of the Australian government just a couple of weeks ago saying how they expect this massive drop-off in pricing in terms of iron ore prices over the next year or two. But at the same time, we've seen, more predictions from the mining companies themselves, like BHP and so on, coming out and saying that they don't expect that pullback to come until the middle of the next decade. So we're talking 2023, 24, 25. So we're talking a few more years of this demand coming through for iron ore from China. And China is the key sector here, as they are in most commodities. I mean, we don't realize, or most people don't realize, just how much of the world's commodities are actually demanded by China. In some cases, it's 50%, 40% of total demand for some of these commodities. Seaborne demand for iron ore is like 50+% from China alone. So it's really the driver of the commodity market. So Kumba, I think, is a special case in terms of that. I can see that market here having some legs to stand on, at least for the next few years, especially if you consider just how the predictions coming through from of course, they have a certain extent a bias to you because they are the mining companies. But historically, I think for the last couple of years, the government has gotten it wrong and the mining companies have gotten it right. So I'm still trusting the mining companies in their forecast that we still got a couple more years, probably till the middle of, say, Alex, the 2020s, before we start seeing China pulling back significantly in steel production.
Well, let's hope so, because those forecasts work in their favor, right? Regarding market expectations and earnings outlooks. But what about Esel? That's also another one that often doesn't necessarily feature top of mind for the retail investor, but also has quite a base for us to consider. Yeah,
probably not top of mind because it's fairly tightly held. I think there's only about a 20% free float in Esel, so it's not widely covered by your research brokers or research houses. So there's not a lot of news, around Esel. Esel, it owns a asset for 50% of an asset called Asmang. African Rainbow Minerals owns the other 50%. They mine iron, manganese, and chrome. And it's been around for a very, very long time. And Viv touched on, the need for high quality iron ore, and I think these guys probably produce the highest quality iron ore. So there's huge demand coming from China in an effort to clean up the environment, etc. So looking back over time, looking at dividends, I'll challenge you to find a company that has been able to, a mining company that has been able to pay dividends. I've looked back 30 years and they've literally increased dividends every single year for nearly 30 years. Wow. Probably, a handful of times that they didn't actually increase, but they've paid dividends every single year, including going through the global financial crisis. So that just gives you an indication of the quality of this business being, operating in this hugely cyclical industry, yet being able to generate that free cash flow given the high quality of the assets.
Something for us to certainly consider, despite some of the pressures on that company. But so often we always think about the mining companies digging into the ground, getting the resource out the ground and bringing up to the surface. But we never think about the equipment that's required in that particular space, right? And I'm assuming this is where master drilling obviously comes in as a particular stock. Is it one that you hold, Viv? You can also jump in and give us your views on this one.
No, so we don't actually hold master drilling just purely because of the size. I just think it's a really interesting little company, proudly South African business. They essentially sell holes in the ground. It's raise bore drilling is what they do, based out in Fochville. It's their own intellectual property. I've actually been out to their operations there, and it's a fascinating, business when you look at it. They can sit in Fochville, which is near Potchefstroom. Probably not too many people know where Fochville is. And they can control their rigs that are sitting in South America, North America, anywhere in the world, from their base in Fochville. Sure. So it's a company that counts, all of the global diversified miners as their clients. They sell their machines. I think they, the only company in the world that can drill some of these holes. They're now looking at horizontal raise bore drilling, so they can drill not just tunnels going down, but tunnels that you can mine in underground, using their machinery. That's, as I said, it's their own intellectual property. It's a fascinating little business, and it's another way of getting exposure to the resource sector or to mining companies without actually going and buying, direct mining exposure.
Who knew that we had all that innovation just right outside of Potchefstroom, of all places, in South Africa? Is this one that you keep or monitor from an assessment point of view?
Like it said, it's a bit too small for like most of our portfolios. That being said, another trend that we have to talk about in terms of the mining sector is the shift towards environmental safety, as well as worker safety as well. It's not just local, it's international. We've seen this huge, of course, the BHP disaster in South America. We've seen a number of these cases around the world where we've had obviously the issues. I mean, even like I'm thinking the commodity sector, Monsanto just had this massive fine for a lawsuit that they lost for Roundup. And this is something that we're going to see going forward. The same, the expertise, the high-level producers of equipment, the high-level miners out there in terms of technology and so on, are going to be the guys that succeed in the market. In the past, you could be, in some place in the world, you can be like cheap and dirty, but I don't think that's sort of a viable strategy anymore. You have to be high-tech and clean at the moment to make it in this world. And I think something like Master Drilling will actually be benefiting from this kind of shift in global trends.
Exactly. Makes sense, and at least there's some good news coming out of the South African mining fraternity. As we know, we've been bogged down with quite a lot of pressure, whether it's mining or operations that also take place. Another proudly South African company within the resource space is Esel. Is this one that you like, Viv? And what's your thesis on this investment case here?
Well, I mean, at the moment, the oil price, looking at the way it is, and the rand looking the way it is,
we're loving it.
I mean, I have a client that has quite a bit of it, and he's smiling at the moment. Yeah, look, it's a case with regards to the oil price at the moment. I think in the short term, probably oil prices have a bit of leeway. They can go to 100 and so on. But here, I think the technology works against the market because of the fracking technology and so on that's happened around the world. We have a lot more accessible oil when we get to a certain level in terms of oil prices. And one of the things that we've seen over the last couple of years is that, even though it hasn't happened this time around, is that the production in the US actually has been like a kind of a barrier in terms of oil prices rising above a certain level. The production in the US tends to rise quite significantly and quite quickly whenever oil prices rise significantly. Right now it hasn't happened, they haven't reacted quickly enough. But I do think in the longer term, the technology is going to trump the demand side on this particular environment.
And should we also be worried about the geographical exposure that they have here, right? They experienced some pressures in Mozambique, saw some ongoing opportunities in the US, which have also come under pressure here. Louisiana, right?
That's it, Lake Charles.
Yes.
So I think Sasol, if you look back over the history, they've got a pretty poor record of, bringing these big projects, online, in time, under budget. And Lake Charles is a great example of that. This is a project it's an ethane cracker that sits there. Yes. And it's been going on, the build of this has been going on for many years. It's run over time, it's run over budget by a long way. And now it's expected to come, I think, online beginning of next year. But I think that still presents a massive risk. It's a huge, huge project for them. It's it's over $11 billion, worth of capex. That's a massive amount to spend on a single project. And when you look at the valuation, I don't think the market's really giving much value to that project at the moment. If you just look historically, Sasol obviously very closely follows the oil price and then the rand-dollar exchange rate.
Sure. And
if you look at that historically, where it sits today, it would imply that the market's not really putting a huge amount of value on Lake Charles. So either they're pricing in that oil price is going to be coming down, or the rand's going to appreciate, or Lake Charles is not worth a hell of a lot, or some combination of those three things. But there's too many, we don't own Sasol at PCS. There's too many unknowns here. There's the macro variables at play that are completely out of their control. Are far too many. So you've got very little visibility. And we've just seen it, beginning of this year, everyone said oil can't go above $60. It hits 60, then the US frackers come online, and then supply, keeps it below that $60. Now we're at 80, and everyone's saying, well, it's going to 100.
Precisely, right?
The price elasticity between, demand and supply is very, very high for oil. No one knows where it's going.
Exactly. And I guess that's something for us as investors to consider, is that ultimately that elasticity is exactly just that. Could go in either direction at any time. So be careful as to how you try to assess the market, right, regarding commodity prices.
That's it.
On point. See, so I'm learning something too here on the show, no doubt. Gentlemen, thank you so much for your time. It's been great hearing a lot more about the assessment of how best to analyze your exposure to the commodities as well as resource space from an investment point of view. A big thank you to both my guests, Andrew Ditburner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Viv Govender, Portfolio Manager for Rand Swiss Offshore. And of course, thank you for tuning in. But do keep your questions and suggestions coming in. And of course, you can tweet us at CNBC Africa using the hashtag PortfolioWatch, or email them to portfoliowatch@abn360.com. Until next week at the same time, have yourself a wonderful evening.